What would you do if today you suddenly inherited a great fortune? Spend it all on pleasures? Gamble it on risky ventures? Or turn it into an asset that sustains your future? In the Bible, the prodigal son chose to squander everything, ending up penniless, broken, and forced to crawl back home to beg his father's forgiveness. Today, millions of investors repeat the same mistake, diving headfirst into meme stock frenzies, cryptocurrencies, and flashy startups, only to lose it all because they lack knowledge, discipline, and the patience to think long-term. Don't let a moment of reckless excitement wipe out a lifetime of hard-earned savings. Invest wisely, with reason, with a plan, and with a vision that lasts. Welcome to Faith 7 Business, where stories ignite faith and strategy. Every word here is crafted to inspire, transform minds, and drive action. Subscribe to the channel and leave a comment. We are committed to praying for your business to grow and prosper. Explore today's lessons to learn how to anticipate market turning points and receive practical advice for both short-term and long-term investments. Avoid reckless risk-taking. A lesson from the prodigal son. Introduction. Imagine you receive a sudden windfall. Maybe a hefty year-end bonus, an early retirement payout, or an unexpected inheritance. In the rush of excitement, you're drawn into buzzing Telegram groups or seduced by promises to double your money in 3 months on a trending exchange. Weeks later, you watch your capital shrink and your dreams of quick wealth evaporate like mist. Sadly, this is far from rare. It's the same age-old lesson Jesus illustrated in Luke 15, verse 13 to 14 about the prodigal son. The younger son gathered all he had, journeyed to a distant country, and there squandered his property in reckless living. When he had spent everything, a severe famine arose in that country, and he began to be in need. This story is more than a warning about wasting material wealth. It's a wake-up call about managing money and making investment choices without discipline. Lessons from the prodigal son. In Luke 15, verse 13 to 14, Scripture describes a young man too immature to steward his inheritance, demanding his share and leaving home with no plan, no clear purpose, and no foresight. He wasted it all on empty pleasures until his pockets were bare. Desperate, he took the lowest job, tending pigs, and envied their food just to survive. This timeless story mirrors the costly mistakes countless modern investors still make today. If we reflect carefully, we see 4 vital lessons. 1. Impulsive decisions, acting without thought. The younger son made a rash demand, took his inheritance, and left immediately, never thinking how he'd grow or protect his wealth, nor how vulnerable he'd be far from his father's care. Likewise, many today jump on hype, a trendy coin, a secret stock tip, or a get-rich-quick project, draining their savings to chase a fleeting chance at fast money. The outcome is often lost capital and shattered trust. Takeaway: let reason govern emotion. Never pour money into something just because excitement or FOMO clouds your judgment. 2. Lack of long-term vision. No safety net. The young man carried money, but no plan. When it ran out, he had no backup, no safety net, and nowhere to turn. Modern investors who only chase short-term gains with no emergency fund or insurance buffer risk financial ruin when markets turn or unexpected crises hit. Takeaway: a wise investor always sets aside an emergency fund covering at least 3 to 6 months of living expenses and never puts all eggs in one basket. 3. Wasteful spending, throwing money at the wrong things. The prodigal son's wealth bought fleeting thrills, but no lasting value or future growth. When the fun ended, he faced empty hands and deep regret. Today, people do the same, splurging bonuses on luxury goods, extravagant trips, or shiny ventures that look impressive but hold no real substance, instead of building assets that generate lasting returns. Takeaway: money spent wisely becomes an asset. Money spent foolishly is an opportunity burned. Use capital as leverage for knowledge, skills, and well-managed, transparent investments. 4. Painful consequences, paying the price in regret. When his money vanished, the son's pride collapsed. No friends remained, no dignity, and at last he crawled back to his father for mercy. Likewise, reckless investing that burns through accounts often leads to crushing debt, ruined relationships, or family conflict under financial strain. Takeaway: don't wait to hit rock bottom to learn discipline. Self-control is the lifeline that keeps an investor afloat through every storm the market throws. Real-world examples: how the prodigal son's lesson echoes in modern finance. These true stories vividly show how the folly of waste, lack of self-control, and reckless risk-taking replay themselves in today's financial world, in markets once hailed as easy paths to wealth. You can continue this section with the real-world examples already provided: meme stocks, FTX collapse, WeWork's downfall, to strengthen the point. C. Final thought. The prodigal son story is a timeless reminder. Manage your wealth with wisdom, discipline, and foresight, or risk losing everything. By combining modern financial intelligence with enduring biblical values, you can be a faithful steward, protecting your assets and using them to build lasting value. Begin your investing journey with caution and vision, so you never have to look back in regret. 1. The meme stock frenzy of 2021. In 2021, a wave of retail investors, energized by posts on X, Twitter, and forums like Reddit, drove the share prices of GameStop and AMC to unimaginable heights. A notable account, @RoaringKitty on X, became the symbolic face of this movement. With half-serious, half-satirical analyses and the rallying cry, "Hold to the moon," millions of everyday investors rushed to buy at peak prices, ignoring the fact that the company's fundamentals hadn't changed at all. When the hype faded, share prices plummeted. Thousands lost their life savings simply because they blindly followed the FOMO wave, a modern-day version of the prodigal son, burning through money without a long-term plan or a real understanding of the asset they were holding. 2. The collapse of FTX in 2022. FTX was once a giant in the crypto exchange industry, marketed heavily as transparent, global, and promising high returns for investors. Within just a few years, FTX reached a valuation in the billions, attracting countless individual investors and major institutional funds worldwide. However, in November 2022, a scandal exploded. The company was revealed to have poor management, misused funds, and hidden risky bets. Practically overnight, FTX declared bankruptcy, and billions of investor dollars vanished into thin air. Millions of people had drained their savings to buy coins, stake crypto, or store their assets on FTX, never checking the legal safeguards, custody structures, or hidden risks behind the scenes. Exactly like the prodigal son, who squandered his inheritance and found himself penniless when the storm hit. The painful fall of WeWork. WeWork was once among the world's most celebrated unicorn startups, with a co-working space model promising to revolutionize how people work. Backed by SoftBank and other large funds, WeWork peaked at a staggering $47 billion valuation in 2019. With the clear and passionate tone of an American adult speaker. Yet behind the glitter, its business model burned cash uncontrollably, expanding rapidly on debt with little regard for sustainable performance. As it prepared for an IPO, financial statements exposed the truth: endless losses, chaotic governance, and a reckless internal culture. The result? The IPO was scrapped. The founder was forced out as CEO, and the company teetered on the edge of bankruptcy. By 2023, WeWork had nearly collapsed, taking billions in investor capital with it, all because so many bought into the sweet dream and ignored the core risks. Lesson: shiny promises can never replace true sustainable value. A wise investor must look beyond the glossy surface to see the real structure underneath. 3. Lottery winners: when big money doesn't mean real wealth. Jack Whitaker, who won $315 million in the Powerball lottery in 2002, is a real-life example of the prodigal son in the modern world. Overnight, he became a multi-millionaire, but with no financial management skills. He burned through money recklessly on casinos, risky real estate deals, and lavish handouts to people around him, believing the money would never run out. Within just 5 years, most of that massive fortune had vanished. He faced family breakdowns, lawsuits, and psychological trauma that no amount of money could repair. Lesson: money is only a tool. Without wisdom and self-discipline, it can easily become a seed of ruin in a person's life. Investor psychology and behavior. Lessons from the prodigal son. The downfall of the prodigal son wasn't just about reckless spending. It stemmed from deeper issues: a lack of self-control, poor understanding, and decisions driven by raw emotion. To this day, these same pitfalls are what drain modern investors' accounts in the market. 1. FOMO psychology. Emotional decisions destroy profit. FOMO, fear of missing out, is one of the most powerful forces pushing people into risky investments. According to a report by Dalbar, over the past 20 years, the average individual investor has earned only 5.19% annually, while the S&P 500 has delivered 9.85% annually. The main culprit: hasty buying and selling, driven by sensational news, rumors, and herd mentality, instead of sticking to a sound long-term plan. Lesson: just as the prodigal son chased fleeting pleasures with no thought for tomorrow, FOMO drives investors into a cycle of buying at peaks and selling at lows, draining both profits and financial peace of mind. 2. Cognitive biases. Hidden mental traps. Another psychological barrier is overconfidence bias, when an investor believes they know it all and can beat the market based purely on instinct. Research from the University of California shows that people who trade too frequently earn an average of 6% less than those who simply hold a steady, diversified portfolio. Additionally, loss aversion bias makes many investors hold on to losing investments far too long, hoping prices will rebound, while selling winning investments too quickly, resulting in returns far below their true potential. Lesson: human nature defends ego more fiercely than it protects the wallet. Staying disciplined and loyal to a long-term strategy is the only real cure for these subtle but costly mental traps. A survey by Standard & Poor's shows that only 57% of Americans have basic financial literacy. This explains why so many pour money into high-risk channels without understanding market cycles, compound interest, portfolio management, or risk diversification. Lesson: money can be earned again, but once knowledge is lost, everything is at risk. Investing in financial understanding is always the most sustainable return on investment. With the clear and passionate tone of American investing, drawing wisdom from the prodigal son. The story of the prodigal son stands as a timeless mirror reflecting classic financial mistakes: acting impulsively, lacking a plan, wasting resources, and ending up with nothing. To avoid repeating the same downfall, today's investors need to build a sound, disciplined risk management strategy. Below are 4 core principles. 1. Do thorough research. Know exactly where your money goes. No one enters a wise investment blindfolded. The prodigal son failed because he spent thoughtlessly. A modern investor fails when they pour money into hype and flashy promises without understanding the real details. Thus, if you invest in stocks, take time to read financial reports, analyze key ratios like EPS, PE, ROE, and follow reputable news sources like Bloomberg and Financial Times. If you invest in cryptocurrency, understand blockchain technology, how tokens operate, the security model, and the legal framework before you click buy. Light bulb. Any investment made in ignorance is not investing, it's gambling. 2. Have a long-term plan. Don't just chase quick profits. The prodigal son had no vision for the future. That's why he burned through everything so quickly. Modern investors risk the same fate without a clear, realistic financial plan. Thus, set clear goals, saving for retirement, buying a house, a college fund for your children, etc. A young investor might choose to allocate 70% to stocks for growth potential and 30% to bonds to cushion volatility. Use financial planning tools like Morningstar, Personal Capital, or Money Lover to track progress and adjust as needed. Light bulb. Investing without a goal is like steering a boat with no rudder. The waves will toss you wherever they please. 3. Diversify your portfolio, the best shield against risk. If the prodigal son had kept part of his inheritance to generate income and part for emergencies, his story might have ended differently. Similarly, investors today must spread capital across different assets to lower overall risk. Thus, a balanced portfolio might include blue-chip stocks, government bonds, indirect real estate via REITs like Vanguard Real Estate ETF VNQ, and a small portion in gold or other commodities. According to Vanguard, a well-diversified portfolio can reduce profit volatility by up to 50%, giving investors peace of mind during market shocks. Light bulb. Never put all your eggs in one basket. A timeless piece of wisdom from Warren Buffett that never loses relevance. 4. Control emotions and maintain discipline. Reason is your strongest fortress. Many investors don't collapse because the market is cruel, but because their own emotions turn every market wave into a storm inside their minds. Practical strategy. Apply dollar-cost averaging. Invest a fixed amount every month regardless of price fluctuations. This removes the fear of buying at the top, selling at the bottom, smooths out volatility, and builds a habit of steady discipline. Real-life example. Contributing $500 per month consistently to an ETF like SPDR S&P 500 ETF, SPY, over many years gives you a strong probability of stable returns, rather than lump sum investing that often catches people at the peak. Light principle. Discipline is the safety harness that keeps you from slipping when the market takes a dive. 5. Seek professional advice. Don't walk the investment journey alone. The prodigal son had no one to guide or counsel him. The result was a squandered inheritance. Modern investors are far more fortunate. There is an abundance of advisors and tools available today. Suggestions. Consult with certified financial planners, CFPs, to create personalized plans, optimize taxes, and build retirement funds. Use robo-advisors like Betterment or Wealthfront to receive automated, cost-effective guidance and avoid personal bias. Light principle. A professional perspective can keep you from making rash decisions during moments of panic. 6. Use technology wisely. Don't let apps become a double-edged sword. Today, it takes just seconds to buy stocks, crypto, or even high-leverage trades on your smartphone. Technology makes everything more convenient, but it also hides traps. Examples: apps like Yahoo Finance, Bloomberg, and Robinhood are excellent for tracking prices and real-time news. However, push notifications like "Price up 5% or "New coin listing" can easily trigger impulsive trades, causing you to lose sight of your long-term plan. Light principle: use technology for analysis and monitoring, not for impulsive, emotion-driven decisions. Invest ethically. Wise stewardship in a biblical spirit. The story of the prodigal son is more than a warning against waste and irresponsibility. At its core, it reveals the principle of responsible stewardship, respect for ethical values, and community impact. Today, these ideals are embodied clearly through the rise of ethical investing. 1. Invest not just for profit, but for long-term social good. In a world increasingly aware of climate change, social justice, and transparent governance, ESG investing, environmental, social, governance, has become a growing trend. Concrete example: the iShares ESG Aware MSCI USA ETF, ESGU, managed by BlackRock, has attracted billions of dollars because it screens companies for environmental responsibility, employee welfare, and transparent governance. Many studies show that companies with strong ESG standards tend to weather crises better, manage risks more effectively, and deliver sustainable profits to shareholders. Light principle: from a faith perspective, wealth is meant to be managed, not squandered. Ethical investing is a testament to using God's blessings purposefully, creating long-lasting benefits for the community, and caring for the environment He created.
2. Forgiveness and learning from mistakes. Wealth may be lost, but the lesson is priceless. The prodigal son's story does not end in defeat. It ends with a father's open arms, a beautiful image of forgiveness and a second chance. In investing, everyone makes mistakes. Buying high, selling low, trusting rumors, losing money due to poor knowledge. What matters is the humility to pause, acknowledge mistakes, and rebuild a strategy grounded in hard-earned experience. Real-life lesson: many investors have lost significant sums during crashes like FTX or meme stock bubbles. But they shifted their mindset, studying seriously, seeking professional advice, diversifying portfolios, and focusing on ESG funds for more sustainable long-term growth. They no longer see investing as gambling, but as a journey of wise stewardship, serving better purposes for themselves, their families, and their community. A practical lesson from the prodigal son for today. The story of the prodigal son is not just a moral parable. It is a vivid guide for anyone navigating the alluring yet risky world of investing. It reveals the inevitable cost of impulsive choices, lack of knowledge, and absence of a solid financial plan. The hard lessons from the meme stock mania, the FTX collapse, and WeWork's downfall all prove one truth: the financial markets never show mercy to carelessness. To avoid repeating these mistakes, every investor should do thorough research before putting money on the line. Make long-term plans connected to life goals. Diversify portfolios. Never put all eggs in one basket. Control emotions and uphold discipline as a fortress for your assets. Seek professional advice. Sometimes an objective viewpoint is worth a fortune. More importantly, combine modern business intelligence with timeless biblical values to become a wise steward. Someone who not only protects capital, but also generates sustainable value for themselves, their family, and the community. Start your investment journey with humility, caution, and vision. Let each dollar earned testify to a living faith, that you have not wasted the blessings God entrusted to you, and you will never have to regret, like the prodigal son. Thank you for journeying with Faith 7. Your follow is more than a number. It's a symbol of faith, a desire for transformation, and a commitment to walking together toward lasting, purpose-driven impact. Stay with us, where storytelling, faith, and strategy come together to spark inspiration and real action. Don't miss the upcoming lessons where you'll discover real-world strategies, transformational stories, and powerful leadership insights crafted just for purpose-driven entrepreneurs like you. Subscribe to the channel and leave a comment. We'd love to pray for your business to prosper and thrive with purpose. Faith 7 Business, always walking with you.